With great respect, what's the strategy that works forward given the treacherous economic waters we wade?
Yeah, this is a good report, and as we've been discussing, across the board, it's a bit stronger than expected. Maybe not on the headline payrolls, but certainly underneath. And I think that really is going to push back, and I think that's why you've seen the market reaction, the initial market reaction that you just described, is bond markets in particular, were really starting to price in a lot of cuts into next year and pricing them earlier and earlier. 3.7% unemployment rate, hard to see where the restrictiveness is coming for this Fed policy. So I think you're going to have a little bit of pushback in that narrative, and that you're not really seeing the slowdown, particularly, again, with the wage picture. Most of the support here is coming from the inflation side, and we'll have that conversation next week. But on the growth side, you're really not seeing the level of restrictiveness show up yet in the labor markets. And I think that's going to push back on how quickly the Fed's going to be able to cut rates to keep up with the fall in inflation and avoid the unintended increase in real rates.
And to Jeff's observation, Lisa, I missed this, stunning. The Bloomberg Financial Conditions Index, I'm going to use this word carefully, explodes to an accommodative 0.62. It's Greek, right? All you got to know is explodes the right word. This is what Powell does not want to see.
Although he didn't push back as much as some people thought, at least last week in his speech. But you're right, to that point, Jeff, when you say that inflation is really in the front minds of people who are betting on this Goldilocks narrative and even rate cuts without the pain, I wonder how much their view is damaged by average hourly earnings rising more than expected and rising from the prior month. How much does that suggest a stickiness to the labor market strength and wage growth that really flies against this narrative of Fed rate cuts next year?
A little bit, and there certainly goes in the opposite direction. But what you've had on the inflation side is really this dichotomy between goods and services. And it's the goods part that has really been the disinflation that's fueling the overall enthusiasm for the cuts into next year. The services side is held up, and services inflation is really the mapping of today's labor report and the wage picture into the broader inflation. And so that, remains very supportive. So again, it's kind of the easy disinflation is behind us. This report kind of supports continued support for the broad inflation picture from the services side. And that debate, I think, will continue. And obviously what you've seen in the market is a little bit of pullback in terms of the enthusiasm. As Jonathan says, the first reaction isn't necessarily the end reaction, but I do think the overall take from this report and the wage picture is, again, very strong labor market, supportive of services inflation. Yes, it's still coming down, but most of that is being driven by the goods side. You're not seeing that supported as much from the services side.